All right, guys. So on May 5th, 2026, the SEC proposed one of the most consequential changes to U.S. public company disclosure in decades. An optional framework that would allow Exchange Act reporting companies, public companies, to file semi-annual reports instead of quarterly reports. So no more quarterly disclosures, semi-annual, twice a year. So if adopted, the proposal would fundamentally alter how reporting structure works in this country and has remained largely intact since 1970, when the SEC formally transitioned from semi-annual reporting to a mandatory quarterly reporting through Form 10-Q, right? We've all read a great number of those. The proposal would permit certain issuers subject to Sections 13A, 15D of the Securities and Exchange Act of 1934 to elect to file one semi-annual report on the proposed Form 10S and one annual report on Form 10K, rather than 3 quarterly reports and one annual report each fiscal year. And this has been framed as kind of a disclosure modernization initiative. The proposal implicates substantially broader questions, though, regarding market structure, capital formation, insider trading risks and the controls related to that, securities litigation and exposure, analyst coverage, right? It's going to change the whole game in terms of the role of periodic reporting and the role that has on modern public markets. Now, zooming out and just kind of for background, the quarterly reporting has been really a defining feature of the U.S. securities regulatory framework in general, right? As a differentiator across other markets across the world. This has been in place for over 50 years after concluding that more frequent standardized disclosure is going to provide more investors with better, more timely, comparable financial information, put investors in a better position to make good decisions, right? And the SEC's current proposal reflects a significant philosophical shift under Chair Paul Atkins, whose broader agenda has emphasized reducing regulatory burdens associated with being a public company, right? Less companies are going public, right? And so potentially this is a move designed to encourage additional participation in the US public market. The proposing release repeatedly links the proposal to concerns, right, that the current reporting regime contributes to declining numbers of public companies and incentivizes excessive managerial focus on short-term performance metrics. I've talked a lot about like channel stuffing, right? And all the different issues that can arise when you're really focused on the next quarter. The proposal also follows several years of renewed debate surrounding quarterly capitalism, right? So this idea of public support for semi-annual reporting from President Trump, the long-term stock exchange, in certain large company executives and institutional participants. But at the same time, investor advocates and analysts and a lot of participants have raised concerns in response to this that reducing mandatory reporting and the frequency is likely going to impair transparency, right? Because there's just a huge amount of time in between disclosures. And so there's going to be an increase in information asymmetries and weaken market discipline. There's more time that people who are in the know, insiders, have information that the public doesn't. And issuers would annually be able to elect either quarterly or semi-annually, essentially by checking a box on the cover page of Form 10K, so you aren't forced to go to semi-annual. But if you were electing semi-annual, you'd file one Form 10S covering the first 6 months of the fiscal year, and then you'd continue filing Form 10K, right, the annual report, and then you'd stop filing the Form 10Q, right? And that election would generally remain fixed for the applicable fixed year. And then the SEC specifically rejected mid-year switching, right? So you can't go from quarterly to annual in the middle of the year, back and forth, because there's obviously lots of concerns there about confusion from investors, inconsistent disclosure timing, right? Gaming the system. Oh, it'd be good to do a semi-annual right now, but maybe we'll go back to quarterly this part of the year, right? They want to get away from that. The idea is that it would mirror the 10Q requirements, but for a 6-month reporting period instead of a quarterly. And the form would require, among other items, like the basic stuff: interim financial statements, MD and A disclosure, legal proceeding disclosures, risk factor updates, disclosure controls and procedure, internal control updates, officer and director trading plan disclosure under item 408, and required, Sarbanes-Oxley certifications. The standard stuff that we're accustomed to, but importantly, the SEC isn't proposing to reduce the substantive content, right, of interim reporting. They're really primarily focused on the frequency. And so in terms of deadlines for Form 10S, it would remain aligned with current Form 10Q timing requirements. So the current rule under 10Q, right, is 40 days after period end for larger accelerated and accelerated filers, and then 45 days after the period end for other issues. The proposal doesn't materially extend the preparation period for interim disclosures. Rather, it just eliminates 2 reporting cycles annually, right? And so one aspect in terms of a positive bucket is, the SEC believes that semi-annual reporting could reduce legal, accounting, and audit review management costs, right? Some fees could be reduced associated with preparing quarterly reports, which is possible, right? The commission expressly notes that issuers could redirect SAGE resources towards business operations, strategic initiatives, R&D, long-term investments. Who knows? Maybe that's going to lead to dividends. But the rationale appears particularly directed towards smaller reporting companies and emerging growth issuers considering whether to remain public or not, right? So if you were barely on the cusp, is this going to make you remain a public company? Or if you were on the fence of whether to go public, maybe this will get you over the hump. This whole idea, right? There's been a huge emphasis on quarterly reporting contributing to managerial overemphasis on short-term earnings performance at the expense of long-term value creation. That's maybe the aspect of this that resonates with me the most, that I think is the most valid. This theme has become increasingly prominent in policy discussions over the last 10 years, really, and has frequently been cited by proponents of reducing reporting frequency in both the United States and also in Europe. So there's some validity there, right? And so I think Chair Atkins has explicitly linked the proposal to broader efforts to kind of reverse long-term declines in US public company participation. It's becoming too complex, it's becoming too hard, right? And so reducing ongoing reporting burdens might make public markets more attractive to private issuers considering IPOs, and reduce incentives for already public companies to remain private or to, prevent them from deregistering, right? And so I think this is one of those areas that there's pros and cons to the situation. Critics of the proposal are obviously arguing that, the decline in public companies is more directly attributable to the growth of private capital markets and, potentially lack thereof in some cases, and venture financing issues rather than disclosure costs alone, right? I don't know that the cost aspect is really a huge issue there, but I welcome people's ideas in the comments. I think one of the SEC's most important analytical premises is that today's disclosure ecosystem differs substantially from the disclosure environment that existed when quarterly reporting was adopted in 1970, right? That we're in a different world today in 2026 than we were in 1970. And the commission specifically points to the evolution of the expanded Form 8K disclosure obligations, the accelerated Form 8K filing deadlines, right? Reg FD, right? And, the widespread quarterly earnings releases and earnings calls, right? That this is adding too much burden to public companies. And we'll see, we will see. There's certainly the issue that I mentioned earlier about information asymmetry and how that's going to weave its way into the situation here. I think it remains to be seen how many companies are going to elect to do this. Are investors going to push back? Are shareholders going to say, no, we really want quarterly reporting, that's really important to us. We've built our whole portfolio and our whole strategy surrounding disclosure and notice happening on a quarterly basis, and we really are going to demand that you keep the quarterly frequency in place. But there's likely going to be others who really rush to adopt this, the semi-annual. So it's going to be interesting. We'll see how these kind of significant unresolved issues end up getting figured out. One big thing to touch a little bit on is just this whole idea of insider trading and trading windows. So I think the biggest concern, I talked about what I think the biggest value is, but the biggest concern is really this whole insider trading controls thing and information asymmetry. The SEC expressly asks, right, whether semi-annual reporting could increase insider trading risk, right, by extending the period during which insiders possess material non-public information. They're just gonna have MNPI for longer, right? There's a longer period where they gotta keep it a secret. And this issue is likely to become central during the comment process, which, you're all welcome to participate in, right? Most public companies structure trading windows around quarterly earnings cycles. Obviously that can be transitioned to semi-annual, but it raises a couple different questions, right? One is, when quarterly internal financial information becomes material, what is that point? Whether issuers are gonna continue preparing quarterly internal financial packages. Are you still gonna run your internal process on a quarterly basis and just not disclose it to the public until semi-annual? How broadly is that information gonna circulate internally? Whether blackout periods are gonna lengthen now. Whether issuers are gonna rely on 10b5-1 plans in the same way. How's that gonna impact 10b5-1 plans, right? Executive trading plans. And also whether voluntary quarterly earnings releases are gonna become necessary simply to cleanse the market, if you will, and reopen trading windows again. It's gonna be interesting. I think one of the biggest announcements that's come out of the SEC this year, in a host of a great number of big changes and things that have happened. If you want to talk about this, you're a public company, you're thinking about going public, whatever issues that you're dealing with, you want to talk any of this through, my name is Braeden Anderson, and I cover these financial regulatory issues for Exchange Act companies. Feel free to reach out. Thanks for watching. That's all for now.